Fair value gaps are one of the most important ICT concepts, and once you learn how to spot them, you'll see how they reveal institutional order flow in the crypto market. So this video is going to explain what fair value gaps are, why they are formed, and how to actually use them in your trading journey. Basically, a fair value gap is inefficiency in price action. It's essentially when the market moves so aggressively that it doesn't trade fairly through all levels. So here's an example of one. In a bearish example, what you want to see are 3 candles. What you want to identify is the low of the first candle, which is the wick, and you want to identify the high of the third candle, which is also a wick down here, and you can see a gap in between. That gap is known as imbalance in supply and demand. Therefore, this is known as a fair value gap. So let's mark on this fair value gap down here. And the reason why we want to look at fair value gaps is we know that price is going to come back at some point into this area to mitigate the inefficiency, to balance price action. Now, to help identify a strong fair value gap, what you want to do is you want to draw on the dealing range, and there'll be more on dealing range throughout the education series for you to understand and identify dealing ranges. So once we've drawn on the dealing range, you can see the highs down here and the lows down here. You want to make sure in a bearish scenario that your fair value gap is in the premium side of the dealing range, and we can identify that this is at least above the 50% level, therefore in the premium side of the dealing range. So now that price has tapped into this fair value gap, we've had a rejection away, but we haven't had a break of market structure. We've actually come back in deeper into the premium side of the dealing range and tapped into an order block. And this is how you can use fair value gaps and order blocks together to help build your trading plan. As we move away, we can see that price has formed more fair value gaps on the way down. And so you can see the low of this candle here and the high of this candle has created a gap between this. So we've identified this fair value gap, and this candle has tapped into this fair value gap down here. So as we move down, we've created a break of market structure. So now let's use the replay tool to identify more fair value gaps. So first thing you want to do is mark on your dealing range. And it's very, very important that you understand where is your main drawn liquidity, because this is where overall price action is going to go. So let's just suppose our main drawn liquidity is to the downside, so we're looking bearish. Now that we've identified our dealing range, the second thing that we want to do is identify the fair value gaps that are in between it. So we have 2 fair value gaps down here. One is down here and one is down here. As mentioned, the key thing to identify is the premium side of the dealing range. We want price to come into the premium side of the dealing range, and once we tap into the premium side, we want price to react from it and come to the downside. So as we move up, price slowly comes in and taps into the premium side of the dealing range, and we've actually created another fair value gap down here as well. So we can mark this on, price taps into it and rejects away from it. So this is known as internal range liquidity because we're still within this premium discount dealing range. Now that we've had a break of market structure down here, what we want to see is how does price react from this? Because what we can see is we've had an aggressive move to the downside, but price is now starting to stall and slow down. So there's possibility that price will move to the upside. This is why it's very important to understand your main drawn liquidity. In this scenario, let's just suppose that there was a key PD array down here that we've tapped into and prices are rejected away from it. The price has taken out liquidity down here. We've tapped into this main drawn liquidity down here, and now we want to see how price reacts from this. Remember, we want price to come into at least this area down here, create a break of market structure, and then confirm that we are now in a bullish trend. So what we can see is an official break of market structure. Price has moved to the upside, and now we want to identify a new dealing range. So we can identify a new dealing range by looking at the lows to the highs down here. So this is the new dealing range we're in. You can see that price has reacted off a fair value gap down here. However, this was of no use to us because we want price to come in at least to the 50% of the dealing range. So in this scenario, given that we're now in a bullish trend, this is known as the discount side of the dealing range. So we can mark on this fair value gap down here. We want price to come into this area down here, and we will start to look for longs. And there we go. You can see a reaction from this fair value gap down here, and price has aggressively moved to the upside. So that's fair value gaps, inefficiencies that show aggressive institutional moves and key areas where price often returns. In the next video, we'll combine these concepts with order blocks and dealing ranges to build even stronger trade setups. If this video has helped you, hit the like and subscribe button for more ICT basics, and let me know in the comments below, do you use fair value gaps for trading?